Today, I want to explain the new federal budget update in a very simple way, especially the changes around negative gearing and capital gains tax. I know these words can sound complicated, but don't worry, I will keep this very simple. If you are already a property investor or if you are planning to buy an investment property, this is something you must understand because the rules are changing. And when rules change, smart investors do not panic. Smart investors prepare, review, and take action accordingly. First, let's understand negative gearing in a simple language. Negative gearing means your investment property cost you more than the rent you receive. For example, you may receive rent, but you also pay loan interest, council rates, insurance, repairs, and other costs. If your expenses are higher than your rental income, you make a loss. Under the current rules, many investors can use that loss to reduce their taxable income, such as salary or business. This has been one of the big reasons why many Australians invested in property in order to get the tax benefits. It helped investors manage cash flow while holding a long-term asset that may grow in value over time. Now, under the new budget changes from 1st July 2027, negative gearing for residential investment properties will be generally be limited to new builds. That means if an investor buys an established property after the budget announcement, they may not be able to use rental losses to reduce salary or wage income after the new rules begin. But here is the most important point for existing investors. If you already owned an investment property before the budget announcement time, which was 12th May 2026, your existing property is protected under the current negative gearing rules until you sell it. So, if you are an existing investor, this does not mean your current property suddenly loses its tax benefit. The government has provided transitional rules that is very important to understand. But it also means the market is changing. Future investors will need to think more carefully about what they buy, how they structure their finance, and whether the property gives them the right cash flow and long term growth. The second big change is around capital gain tax, also called CGT. Capital gain tax applies when you sell an asset, like an investment property, and make a profit. At the moment, if you hold an asset for more than 12 months, many investors can receive a 50% capital gain tax discount. Under the new budget changes from 1st July 2027, this 50% discount will be replaced by the system called cost based indexation, and there will also be a 30% minimum tax rate on capital gains. Again, let me explain that in a simple word. Instead of automatically reducing the taxable gain by 50%, the new system will adjust the cost base for inflation. In simple terms, the government is saying we will tax the real profit, not just the inflation part. For assets you already own before 1st July 2027, the gains made before the date are generally protected under the rules. The new system applies to gain after the date. So again, existing investors are not being completely hit overnight, but the rules are clearly moving in a new direction. The government says these changes are designed to make the system fairer, help first home buyers, and encourage investors to put more money into new housing supply instead of competing mainly on established homes. Whether you are agree or disagree with this policy, one thing is clear: investors must now become more strategic. In the past, some investors bought properties mainly because of tax benefits. But going forward, that approach may not be enough. You cannot simply rely on negative gearing or tax discount to make a poor investment look good. The fundamental matters more than ever. You need to ask better questions. Is this property is a strong growth location? Is this is there any population growth? Are there jobs, infrastructure, and rental demand? Is the cash flow manageable? Can I hold this property comfortably if interest rates or expenses increases? Does this property help me move closer to financial freedom? This is why I always say property investing is not just about buying any property. It is about buying the right property in the right location with the right strategy. For existing investors, this budget update is a wake up call. It is time to review your portfolio. Some investors may be holding properties that are not performing well. Some may have equity sitting unused. Some may have loans that are not structured efficiently. Some may have opportunities to refinance, improve cash flow, and reposition their portfolio before the new rules fully start. This is not the time to sit back and ignore changes. This is the time to speak with your accountant, mortgage broker, and property strategist. Understand how these changes may affect you personally. Every investor's situation is different. A person with one investment property is different from someone with multiple properties. An employee is different from a business owner. A young family is different from someone close to retirement. So please don't make decisions based on fear or social media noise. Make decisions based on proper advice and clear strategy. For investors who are planning to buy, this message is clear. There may still be opportunities, but the strategy may need to be changed. New builds may become more attractive for some investors because they can continue to access negative gearing under the new rules if they meet the requirements. But even with the new builds, you must be careful. Not every new property is a good investment. You still need to look at the land value, location, demand, supply, rental appeal, and long-term growth potential. The big lesson from this budget is simple. Tax benefits should support a good investment. They should not be the only reason you buy. A strong property investment should make sense even before the tax benefit. The tax benefit is a bonus, not the foundation. I also want to existing investors to see the opportunity here. When rules change, many people become confused. Some people delay, some people panic, some people do nothing. But educated investors take a different approach. They learn the rules early, review the position, and make decisions before the crowd catches up. If you already own investment property, you may have an advantage because your existing negative gearing position may be protected. But that does not mean you should be passive. You should check whether your property is still aligned with your long-term wealth plan. Remember, the goal is not just to own property, the goal is to create real freedom. That means more passive incomes, less financial stress, better choice for your family, and strong future. So, what should you do now? Start with a simple review. Look at your current properties, your loans, your cash flow, your tax position, and your long-term goals. Ask yourself if the rules are changing. Is my strategy still strong enough? If you are not sure, get help. This is exactly where the right guidance can save you time, money, and stress. My, mes- my message to you is very simple. Don't panic, don't ignore it. Don't wait until 2027 and start thinking. Use the time wisely. Get educated, review the numbers, understand your options, and if the right opportunity is available, take action with confidence. Because in every market change, there are two types of people. One group complains about the change, the other group understand the change and use it move forward. Be in the second group. If you want help reviewing your property strategy or understanding how the budget update may affect your property journey, reach out to me. I'm Sudesh, working as a buyer's agent. I help busy professionals like you grow wealth through real estate. This video is a general education only. It is not a personal finance or tax advice. Please speak with your accountant, mortgage broker, or licensed professionals before making a decision. Thanks for watching. If you found this helpful, share it with your friends, someone planning to buy property. And remember, the right strategy can help you create real freedom in your life.